Hi, it's Nero here from Investment Rise, and there is no doubt that your opinion of the headline to this episode will be coloured by where you live. I mean, if you live in Sydney or Melbourne right now, you're like, there's no way property prices can keep rising, right? More than likely that's going to be your opinion. However, if you live in like Brisbane or Adelaide, you're like, yeah, of course they're going to keep rising. I mean, did you see how much that property sold for over the weekend? Right? So the question then is, how do you predict what's going to happen to the future of property prices in perhaps either the suburb that you're living in, the suburb that you're targeting, or if you're just trying to work out, well, where should you invest if you're starting to a portfolio in 2022? What areas should you target? And how do you work that out based on data? Because the key thing is that we need to know what are the data points to focus on when we're trying to work out when to invest and where to invest. Because if we don't know what the key data points are to focus on, then all we're left with is noise, media headlines, and people's opinions. Okay? And that can leave us feeling very, very vulnerable because it's often the opinion that we hear more often that we tend to believe, or the people who seem to yell the loudest or get more time in the mass media. Okay? So the good news is there is a key data point that we can focus on that will help us then determine whether that's a suburb that you should target and explore further for future capital growth, or if it's a suburb that you should just leave for now. And yes, I do mean suburbs, because remember, when you're investing in property, you're not investing in the general market. You're not investing necessarily even in a particular city, especially if you're targeting a capital city. You're investing in an individual suburb. Okay, and you want to know, well, what's the likelihood of strong capital growth in that suburb if that's your goal? Okay, so let's have a look at what that metric is. Now, before I tell you what that is, let me ask you a question. Are you someone who likes to grab a bargain or grab a good deal? Now, I don't know you, but the odds are you probably said yes, and definitely most people listening to me will have said yes. Okay, but when it comes to buying an investment property and choosing the best suburbs to target in 2022, it's almost counterintuitive because you want to target the suburbs where you have less of a chance of getting a bargain and getting a good deal. Right? Here's why. The key data point that we target is known as average vendor discounting. So what that means is that if you're targeting a suburb where property sellers have to discount their property in order to sell it, if it's quite easy for you to negotiate and get a good deal and get a bargain, then the odds are that you're targeting a suburb in 2022 where there isn't a lot of demand, or rather, supply is more than demand. Okay? And if you've been following my work for any length of time, I think I've made it clear on so many occasions that property prices are essentially a function of supply and demand. If you target a suburb where supply is greater than demand, odds are prices will either stay flat or probably fall slightly. But if you can target a suburb where demand is greater than supply, then odds are prices will rise. Okay? And so when you're targeting a suburb where it's easy to get a discount, that means you're targeting a suburb, especially in 2022, where there isn't a lot of demand, or as I said, supply is more than demand, which means that the odds are the capital growth is going to be muted. On the flip side, if you target a suburb where it's hard to get a discount, okay, where there are lots of buyers for every property, and essentially you need to pay market value, as much as it may not feel good because you can't get a discount, the odds are that you're actually targeting a suburb which has good scope for capital growth going forwards from 2022 because demand is higher than supply, and therefore the vendor doesn't need to give a discount. Now, let's however look at, say, Sydney. What's happened to the Sydney property market over the last few months? So this is an article from The Domain from March of 2022, and it says, 1 in 10 Sydney homes for sale in February were discounts. Okay, so what that means is that 10% of sellers had to take a discount in order to move their property. So let's keep reading. 1 in 10 homes for sale in February were offering discounts, a share that is only likely to grow as long as sellers expect 2021 prices despite the market slowing since. New Domain data shows the average proportion of listings where sellers discounted the price in Sydney jumped from 5.9% in July during the city's second major lockdown to 10.5% in February once the property market was back in full swing. And now if we go and look at the actual what's happened on a month-by-month basis, again, this data is all according to domain.com.au. What we can see in July of 2021, 5.9% of listings had to entertain a discount, but the average discount was only 4.4%. And then if we go to November 2021, we can see that 10.9% of properties had to get a discount, which means that 10.9% of sellers had to discount the property from their asking price in order to sell the property. The discount though was only 5.4%. And now in February, we're sitting here at 10.5% of listings, 10.5% of sellers having to discount their property in order to sell the property, but it's only a discount of 5%. So what does that tell you? Well, if you look at the Sydney market as a whole, okay, and this is Sydney as a whole, this is not individual suburbs, but Sydney as a whole, it shows at the moment that roughly 1 in 10 sellers have to take a small discount of roughly 5%. Now, if that's going to continue, what are you going to see? You're probably going to see a fairly flat market throughout most of Sydney. You're going to see the data show that in some months property prices have dropped a little bit. In other months, the data will show that property prices have risen. But generally speaking, if these trends continue, property prices are going to stay roughly where they are with very little movement one way or another. So does this mean that this is the case everywhere around the country? Definitely not, okay? Let's have a look at now 3 suburbs from 3 totally different areas around the country. I'll say one of these suburbs is in Sydney, and let's have a look at what the data shows this time from CoreLogic. So what you can see here is that suburb number 1 has a median sale price of $1.1 million. This is for houses only, but the vendors only have to entertain a discount of not 14%, but 0.14%, okay? Well under 1%, well under even 0.5%, all right? So what that shows you is that if a vendor, a property seller lists their property for a fair price, they're essentially not going to have to take any discount at all. So let's have a look at another suburb. Here we go. Median sale price, $465,000. Yet the average vendor discount is only 0.05%. Okay? It's as close as zero as you're probably going to get. Okay? Or here's another suburb. Here we have median sales price of $588,000. Again, houses only. Look at the vendor discount. 0.04%. So what's the key takeaway message here? It's that don't think that the entire property market is behaving the same way as perhaps what your local area is behaving like. Okay, like for example, where I live in Sydney right now, there is no doubt that property prices are not rising anywhere near as steeply as they used to. Vendors are definitely more negotiable. We are even seeing listing prices down from where they were 3-4 months ago. Okay, and that's just where I live and in the surrounding 3 or 4 suburbs. But I'm well aware that that's not how the property market as a whole is behaving. So if I was looking to invest personally, and let's just say my budget was something that could meet the areas where I live, would I necessarily target those particular suburbs? Well, it would depend on my goals. Right? If I'm looking for some short-term capital growth plus long-term capital growth. So short-term capital growth means I want to target a rising market, but long-term capital growth means I also want to look at the other fundamentals in the area, like population growth, infrastructure investment, etc. Well, where I live probably wouldn't be where I'd be targeting right now. Okay, but then as I just showed you on the screenshot earlier on, there are some other suburbs out there that have some very low vendor discounts. Now again, you don't then just rely on that metric solely, right? That metric pretty much says, okay, that's now a suburb worth targeting. Let's do some more research and look at the other factors that are going to give you more chances of capital growth. Because remember, no one's got a crystal ball. Nothing that I'm telling you here is advice. It's just based on my 20 years of investing experience now and 12 years of experience helping others invest in property. And so what I'm sharing with you here is what we do. And so once we target suburbs, or once we find suburbs that have a very low average vendor discounting rate, then that triggers us to investigate further, to look at things like, what's the industry around the area? Is it diverse industry or is it a single industry area? Okay, we want to look at other metrics as well in terms of local amenities. Now, what's around the area? What new infrastructure is coming? Okay, so this metric will help you target the suburbs that have the best potential for capital growth, and then you're going to have to do some subsequent research. But there is no doubt about it that different suburbs are going to perform differently in different cities. Okay, so you need to really sort of discard the noise, start looking at the key research terms, or get some professional help if need be. But there is no doubt in my mind that here we are as I record this in 2022. If we project forwards 3-4 years, you will be hearing stories about investors who took action in 2022 and are now reaping the rewards of their research and their hard work. At the same time, in 3 or 4 years' time, you will be hearing stories about some investors who say, I wish I'd taken action. I wish I'd invested. I wish I'd gotten the help that I needed rather than maybe sitting on the sidelines and believing what's in the mass media. The question for you as you listen to this is, which camp are you going to be in? Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you're looking for a proven recipe, a blueprint on how to build a property portfolio that gives you passive income, then click the link below this video and get a copy of my book, Wake Up Wealthier, How to Build a Property Portfolio that pays you an income each and every month. Okay, when you click the link and you download your book, you can get both the digital version and the audio version in case you don't like reading. All right, so I used to sell this book for $49, but right now I'm making it totally free. Why? Because I want more people to get this information, and I know that a segment of you will then like what you see in the book and choose to reach out to find out more about our services. But even if you don't, if you're serious about building a property portfolio that pays your passive income, then you really want to get my book, Wake Up Wealthier. It contains the secrets that I have fine-tuned over the last 19 years. It's totally free for a limited time. Click the link below.